Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Home Depot stock. This is another one of those home renovation companies that is getting beaten down this year. Last year, the stock was over $400. Now we're all the way down to 300. And really, in the last 5 years, I mean, this stock has gone up and down a little bit, but I've owned this stock before, and I just remember it, it doesn't really go anywhere. It kind of just goes up and down. And that's kind of what we're seeing now. It's definitely trading on the cheaper side of things now. So this is around a $300 billion company, and they have a dividend yield of 3.1%. I think everybody knows what Home Depot does. And so if we look at Claude's analysis here, we can see that 23 analysts have a buy rating on it with an average price target of $416. That's a decent amount up from where we're at today. So that would definitely some money to be made there if it gets to that level. Then if we look at the EPS estimates, we could see that I actually like looking at it better on this chart on Qualtrim here. We could see that the revenue has pretty much been flat, and they're doing $165 billion of revenue. And then next year it's supposed to grow 4% to 171. Following year, 4% growth again. And then as for net income, it's just been kind of flat, and it's just down from where it was in 2022. And this is just super similar to the company I just did an analysis on, which is Pool Corporation. It's the same thing in that right after that pandemic period, like 2022, that's when things were peaking for these home renovation companies. And since then, it's been rough. We've had inflation, we've had interest rate changes. There's just been stuff affecting the economy, and so I think that's what's hurting these companies' numbers. Same thing with free cash flow. The dividends have gone up slightly. Shares outstanding is basically flat, which is good. This company, Home Depot, always has a lot of debt, which sucks, but that's just the way it is, which I don't like that. But that's just the way it is. Ratios, there's one thing I want to point out about this. So profit margin of 6%. Let's look at this on an annual basis. Let's do annually. So here's the thing. So I've owned, I think a year or two ago, I owned Target. And then right now I own Pool Corporation. And then I just did analysis yesterday on Tractor Supply. These retailers, so like Target, for example, Target was a mess these last couple years. And some people will blame it on the whole woke agenda thing, which, maybe that contributes to some of it because there was some pushback on that. But at the same time, I don't think that's the whole story because it's just retailers are struggling now. And like I said, there's different things like inflation and stuff going on. But my point here is that Target was a mess of a stock these last couple of years. I sold it last year, and the stock is still basically at the same price it was back then. But my point with this is the PE that these companies trade at. Because if you look at the PE between, let's say, Target, Tractor Supply, and Home Depot, well, their sales are all pretty much flat, okay, and then you could add Pool Corporation in there too. The revenue will actually Pool Corporation I think is declining more, but let's just say retailers in general, the revenue is pretty much flat, and the net income though is down, okay, and their margins are down. So look at for 2026. See, this is even off a little bit. The point here is since 2022, it's been declining. 2023, it's been declining. But with that being said, I before I went to go buy, like, I don't think I'm gonna buy Tractor Supply yet or Home Depot. I still need to do some more research on Home Depot, but like the return on capital employed, I have to say it is highest for Home Depot. The ROI here, even though it's been downtrending a lot, it's almost half of what it was 4 years ago. These numbers are much better than what Target and Tractor Supply does. So part of me was thinking, okay, what should I be buying a retailer like Home Depot or Tractor Supply when Tractor Supply is at 14, 15 times earnings, this one's at 19 times earnings, but Target was trading at 10 times earnings for a while last year. And that just makes me think, you know, why can't these retailers also go down to 10 times earnings? Because, like, let's say Tractor Supply, for instance, that one looks really cheap and it looks kind of interesting. I kind of wanted to buy it at 14, 15 times earnings. But, in the back of my head, I'm thinking, like, it could go down to 10 times earnings. And then that could be a big drop, right? I could go down 30% or something. And that's what I'm afraid of. So Tractor Supply, I'm still thinking about. This one I'm still thinking about as well, but I just think it's important to see that. So like this company, their sales is maybe a little bit better because they are growing at 3 or 4% per year, so it's just okay. But net income's down, free cash flow is down. But I think the main thing setting this one apart is the fact that their ROI is way better. I mean, they're doing 29% ROI. That's much more attractive of an investment than a company like Target or Tractor Supply that might only have like 13% or something. So that's why I think this one is trading at a higher PE, but it's just something to think about. Let's go down here to the valuation because this is important to look at. So here's the last 5 years of the PE. We are like in the middle of bullishness and bearishness, I would say, because you look anywhere between 2022 and 2023, the PE was between 15 to 20 basically during that time. And right now we're at 20. So we're just about to enter that territory of like ultra bearishness where that's probably a good time to buy versus anything above like let's say 22 and above. That's where I mean, you could buy it at 22 times earnings and do fine. You could make some money on that. But there's less upside, and especially if you're buying at 25 or 27 times earnings, that's where it's kind of like you're not getting a great deal, and so you're most likely you're not gonna make that much money. Free cash flow yield it's just starting to enter again. It's just starting to enter attractive territory because now we're starting to get past the midpoint. We're heading up into higher numbers there. Price to sales is surprisingly down to nearly, whatever, a 6 or 7 year low or whatever. Um, but this is the cheapest it's been on, let's see, let's look at the last 10 years. See, so we're all the way down here. So the last time it was this cheap, we saw a little bit a couple years ago, but really we haven't seen it since the pandemic. So I mean, price to sales basis is nice, but I'm seeing that across a whole lot of stocks right now. The price to sales is much lower, but the PE or the free cash flow, the price to free cash flow is not, and that's just because of margins and the inflation right now hurting a lot of different companies. So, is this an attractive investment right now? I would say it's just starting to enter the territory of attractive. I think it could definitely go down more. If the stock was $250 tomorrow, then I would say it's a good buy. But right now, and I mean, even right now, you could make some money. It's just, is it like jumping out at me like in a tremendous opportunity? Not really. And in terms of the other thing I like to do here is let's just take a conservative PE for the stock. So we'll say, I mean, we're at 20 right now, which is right in the middle, or it's like 21. Even like 21 is a good number. 22 is likely, but let's just say 21 and then multiply that times 21 times the 14.5 they should do. That gives us a $304 stock, which is where we're at right now, right? But then you take 21 and you multiply it times next year's. Well, then we're looking at about $330. So would I want to buy this hoping for a $330 stock next year? No, that's not really worth it. I would like to make at least, I'm looking to make 30% plus. So that's kind of the thing here. I think that's it for now. I mean, it's not like, I mean, I don't think this is a dying business. It's just the margins are bad right now, like every retailer. And I think things are going to turn around at some point. I don't think this is like company a company problem. I think it's just the market and the economy right now that we're in. A lot of retailers are struggling. So I think once things turns around at some point in the next couple of years, it might not be this year, but in the next couple of years, we'll see a growing economy and we'll see things get back to where, consumer sentiment is stronger and stuff. And when that happens, then we should see more home renovation and all that stuff. And then we'll see what happens. But those are my thoughts on Home Depot. Let me know what you guys think down below, and I will see you in the next video.